Hey everybody, this is Alex Merced, instructor here at Greco Financial Training, and you're listening to another episode of Mastering Financial Exams. We're going to be going over many of the topics that you see on exams, like the Securities Industry Essentials, the Series 7, the Series 24, etc., that help you better, do better on those exams. So today's topic is bonds. So mainly we've talked about equities last several episodes. So today we're going to be talking about bonds. And bonds, what they are securities that represent debt. So when you buy a bond, what you're doing is you are making a loan to the issuer of the bond. So if you were to buy a GE, a General Electric bond, you are lending General Electric money. And in hopes that you get paid back the money that you lent them plus interest. And that would be sort of your taxable gains. Okay, taxed as interest or ordinary income. Now, there's a couple different ways that bonds are structured. This is why bonds tends to be a very tricky part of the test, because there are so many different types of bonds, and they all have such unique differences that it can sometimes be overwhelming on a lot of these exams to keep track. So I highly recommend enrolling in one of our courses over there at Greco.com, so that way you can get all the supplements, the handouts that really help kind of make all this much more retainable. But a couple different ways that bonds are structured is what's called a coupon-bearing bond. And the reason why it's called a coupon-bearing bond is because back in the day you had what was called a bearer bond, which was a physical bond certificate with all these little coupons attached to it. And they represented the interest. So you would have like a $1,000 certificate. That's generally the standard face value of a bond, also known as the par value. And the par value never changes. Why? Because you can't reprint the certificate. So if it says 1,000, it's 1,000. So you'd have a $1,000 certificate that represents a $1,000 loan that was originally made to the company. And then it would have some sort of interest rate, which was known as the coupon rate or the nominal rate. So let's say 10%. So each of those coupons would represent a payment based on 10% interest. So 10% interest would be 10% of $1,000 would be $100 a year. But instead of paying you $100 payment every year, they would pay you every 6 months. So every 6 months, you got $50. So 2 payments a year, you would get $100 a year. And you would physically take those coupons to the bank, cash them in every 6 months until you've cashed in all the certificates, and then you would cash in the actual certificate on the last day and get your principal payment along with your last coupon. So that was sort of a coupon-bearing bond. Nowadays, there's no longer bearer bonds where you have the physical certificate. They're either fully registered, where you still have a certificate, but they just wire the money to your account, or they're in book entry, where it's just a digital record that you are owed this money. So that's the story there. Then there's what's called a discount security. A discount security is a type of bond where the interest that you make is done a little bit differently. So instead of you getting interest payments every year, you will buy the bond at a discount to its face value. So since the face value is generally always 1,000, you'd buy a $1,000 bond, but you'd buy it for, let's say, $500. And then at the maturity date, at the end date, you'd get paid back your $1,000, but you'd get paid back nothing in between. So let's say I buy one for $500 that pays me $1,000 10 years from now. So essentially I make $500, okay, but I don't make it till the very end. That's called a discount security, sometimes better known as a zero coupon bond, because there is no coupon payments in between. So those are generally the two main structures of a bond, okay? But bottom line is, it always represents money you're lending the company. Every bond has a face or par value, which is always 1,000. Coupon-bearing bonds have a coupon or nominal rate of interest that it pays you interest payments on. Discount securities generally give you your return through the discount off its face value. So generally the return you make is expressed as what's called a discount yield. So you'd figure out what the discount is as a return over the life of the bond. So to keep it simple, let's say it's a 1-year bond and you bought it for $900. Well, $100 over $1,000 par value is a 10% return, or a 10% discount off 1,000. So that'd be a 10% discount yield. So that's kind of how those discounted bonds work. So those are the two main structures of bonds, and we're going to be, in the future episodes, we'll talk about the different issuers of bonds, whether they be corporations, municipalities, the treasury, etc., and what are the sort of unique differences between these types of bonds. But if you guys enjoy the show, make sure to leave a review over there on iTunes, Google Play, Stitcher, Spotify. Make sure to subscribe, and make sure to go over to Greco.com and consider enrolling in one of our courses to get you past these exams. And continue listening to the show anyways, because there's a lot of cool stuff to learn just by listening to the show. So have a great day and enjoy.